Shares of Disney are plunging after the company released its fourth quarter earnings that missed estimates. The company's revenue drop was led by the entertainment division, which includes streaming, TV, and films and businesses. Let's bring in now Ken Leon, Research Director at CFRA Research. Ken, thanks very much for joining us.
Great to be here.
How would you describe this? I think you're thinking it wasn't all bad.
Well, I think what's happening here with Disney is great reputation, but I think the magic is wearing off. Investors or even analysts are saying that it's very hard for a complex company to drive organic growth and profitability. And it's hard to get all the business segments to fire on all cylinders. So with that, we downgraded the stock today from buy to hold.
And what does that mean? Could you see sell-offs coming?
What we see is a company that is having difficulty driving even high single-digit growth in its businesses, such as the theme parks or experiences, as well as sports, which is ESPN. At the same time, if there's an area where you could see outsized growth, but coming from a small base of making money, is in streaming, direct-to-consumer segment. As we see a decline in their linear networks of broadcast and cable TV, it's both on subscribers as well as advertising sponsors.
What's your biggest concerns with it?
I think for Disney, you have to remember that when you look at entertainment today, it's moving very fast, and there's also other enormous new entrants in the last year or two, such as YouTube TV and Amazon Prime Video, or even Apple, that have very deep pockets. So for Disney to really excel in all areas and deliver higher growth is going to be challenging.
And that battle with YouTube over their distribution of channels, is that having an effect?
I think that's just a contract tiff. What Bob Iger said that for the last question in the conference call, saying that they're just going to be bringing rates to what other providers have with YouTube TV. But don't underestimate that other than Netflix, the company with the largest total subscribers is YouTube TV, and that's just their paid users. And when we look at the landscape, whether you're watching sports on a Thursday night, NFL football, or NBA, you're going to see Amazon Prime Video, and you'll even see Netflix, for the Christmas NFL games.
Is there reasons for optimism heading into the new year?
I think there is. The U.S. economy is still strong, and that's important in terms of the theme parks, which is the cornerstone of Disney. We haven't seen any major dip, but it's become more tilted to the higher demographics that can afford very expensive 2 or 3 days in the park. When you look at the rest of Disney, though, I think what investors are just not going to give them the benefit of the doubt of having 20 plus years of great operating and financial performance, because the landscape has changed. And Disney also has to address CEO transition, succession, because Bob Iger said he's going to be leaving or retiring in 2026, maybe the end of the year.
I was going to ask, how much of a factor is that Iger leaving?
I think the new hire will be internal this time, again, I guess, but they have some really good leaders. I don't think this is a Bob Iger situation as to how you get the businesses to grow from here. We just have to see better execution. But one thing, and I touched upon examples of live sports, is there's a big decline in spending for movie film production or TV episodes, mostly because films are a high risk. Even in the third quarter, Disney did not have any really strong movies. But then also the advertisers are really shifting their sponsorship not to TV episodes, but to live sports.
And so where does that leave Disney heading? What do they need to do that would make it attractive to investors again?
So the party line would be, we have all the pieces in place to compete and to succeed. I think that's true, unlike Warner Brothers Discovery or even Paramount. But in the case of Disney, I think they're going to have to show stronger execution in their experience, which is their theme parks and cruises. And additionally, they got to get the streaming business direct to consumer to continue to have significant gains of subscribers and profitability. So it's not one specific thing, but obviously, if you're going to have a low single-digit grower at large for the company on revenues, you're going to have operating efficiency to drive wider margins.
And with those two things that you mentioned about the Disneyland and the cruise ships, and then also subscribers, is there only so much of a pie there, or can they grow those pies?
Well, it's an important one. It's one that certainly has less competition, maybe Comcast with Universal Studios, which just introduced Epic, its second major park in Orlando. Disney's committed to spend $60 billion in CapEx for improving theme parks or bringing on more cruise ships. And they have kind of a license contract and a management contract to open up a new theme park for Disney in Dubai, but they don't have to put equity into it.
Okay, so there is, for some, there may be a fairy tale ending for it for 2026.
We hope so.
Okay, Ken, thank you very much for joining us. We appreciate your insight as always.
Thank you.
Ken Liana is Research Director at CFRA Research.